Welcome, dear traders. A year ago, Jerome Powell reassured investors that inflation would be transitory. He also favored a dovish stance. Nowadays, the Fed is the most hawkish regulator that tightens policy at the fastest pace in 4 decades. Traders backed themselves into the corner when they began to price in less aggressive rate hikes. They expected rate cuts in 2023, despite the hawkish statements of Fed policymakers. Now they are facing the consequences. The latest comments from Fed officials made markets even more anxious ahead of the Jackson Hole Symposium. Stocks are falling while the US dollar has reached new highs. Asian stock markets declined on a Wednesday, extending losses for the 8th session in a row. It's quite surprising given that US stocks slightly recovered yesterday after a 2-day losing streak. Weak US data eased concerns about aggressive rate hikes, and short-term Treasury notes also managed to rise. Today, the economic calendar is uneventful. The published reports were of less importance to traders. They are now looking forward to the symposium as economic prospects seem rather dismal. China's economy is also cooling down. Small rate cuts have only confirmed the problems in the real estate sector and a weaker credit demand. Investors are now mulling over new comments made by Fed policymakers. On Tuesday, President of the Minneapolis Fed Neel Kashkari delivered a speech whose tone was also hawkish. He stressed that the Fed's priority is to cap inflation. He noted that his biggest fear is that the Fed and financial markets are underestimating underlying inflation pressure. Like other Fed hawks, Kashkari believes that the Fed will have to put up with a contraction in economic expansion if it helps rein in inflation. The manufacturing and services PMI indexes revealed yesterday disappointed traders. In June, new home sales slumped to a multi-year low. To some extent, this is good news. The weaker the economic data, the less aggressive rate hikes will follow. Nevertheless, these reports will hardly make the Fed change its rhetoric at the Jackson Hole Symposium this week. On Wednesday, the US dollar index retreated to 108.70. Before that, it touched again a 20-year high as Neel Kashkari's hawkish speech eclipsed weak economic data. Investors hope to get more clues from Jerome Powell's speech about the pace of monetary tightening, and they are now uncertain whether the Fed will raise the key rate by 75 basis points for the 3rd time in a row, or by 50 basis points in September. In his testimony, the Fed chair is likely to dispel rumors about monetary easing in 2023, and his speech will determine market sentiment until the September meeting. The US dollar has been rising for the 6th day in a row. It could log the best weekly performance since March 2020. A distant target will be the 121-point level. To approach it, the US currency needs to consolidate above 109.20, which is the high of July 14. As seen on the chart, there are no pivot levels that could help the bulls to push the price to 120.50, a high of January 2002. The main target level is located at 121 points, not far from the high of July 2001. If this scenario comes true, the US dollar index will have jumped by 10%. Is it feasible? It's hard to say, as anything could happen on forex. The yen experienced a sell-off, and today the dollar-yen pair has stabilized at 136.70. Traders are still digesting yesterday's US data, and they are trying to understand whether weak macro stats may force the Fed to slow down the pace of monetary tightening. There are also rumors that September will be the last month of an aggressive rate increase. A rally of the US dollar depends entirely on the Fed's hawkish stance, so any changes in the monetary policy will significantly impact its trajectory. However, this is a long-term prospect which is not backed by real facts. Traders are bracing for high volatility as Powell is expected to confirm further rate increases. Meanwhile, the Bank of Japan has repeatedly stated that it will maintain an ultra-soft monetary policy to support the fragile economic recovery. The Bank of Japan's monetary stance differs significantly from other major central banks, which have shifted to monetary tightening. The regulator is expected to keep its current policy unchanged, even after the main and core inflation figures accelerated to multi-year highs and remained above the central bank's target of 2%. The bulls are still poised to push the pair to 140, and the Australian dollar is still in the bearish close. There are also no positive drivers which could help the pair regain momentum. The AUD USD pair is declining due to internal headwinds as well, and traders are still puzzled by the controversial employment report. They are unsure about how aggressively the Reserve Bank of Australia could raise the key rate in the coming months. Australia's unemployment rate fell to a 48-year low of 3.4% in July. Nevertheless, net employment unexpectedly declined by 40,900 versus the forecast reading of 25,000. And the Reserve Bank of Australia was projected to hike the benchmark rate by 0.5% in September. Yet traders are now casting doubts on such a rate increase, given the dismal report. In the Asian session, the AUD USD pair was trading around 0.6900, and it's likely to slide into the consolidation phase, moving in the range of 0.6850 and 0.7000. A further decline in the quotes looks possible. If so, the price will face a strong support level of 0.6830. And yesterday, the AUC tumbled to 0.6856, but then rebounded sharply to the resistance level of 0.6960. It means that the price has reached the bottom, and there are no fundamental factors that could intensify the downtrend. And this is why the pair could trade in the sideways range. Now, investors are looking for clues about whether inflation has perked. Any signs of it may indicate a more favorable scenario for the US economy and the global one. Judging by the dismal situation in some markets, it's still early to count on a steady recovery. And that's all for now. Subscribe to our channel and keep your finger on the pulse with us. See you soon.